Welcome to Requity Insights, a channel dedicated to documenting our journey to 100 world-class communities. Welcome back to Requity Insights. This is Dylan, and today we're going to be speaking on a topic that is one of the hidden secrets that has helped us raise millions of dollars over the last few years, and is one of the number one drivers for both us and our investors when it comes to reasons to invest into real estate. This can be often overlooked, but is without a doubt one of the reasons that many of the wealthiest people in the country invest in real estate on a regular basis. It is the tax advantages of commercial real estate. And today we're going to be breaking it down and sharing with you the 5 big tax benefits that commercial real estate investors have, and going into the weeds on the ins and outs on how real estate investors receive these tax advantages. I know a lot of people hear, real estate is tax efficient, and a lot of people hear these stories about real estate investors that didn't end up paying any taxes at the end of the years, but not everyone is familiar with the mechanics behind how it's possible. So today I hope to be able to clear that up for you and break it down into sort of bite-sized chunks that will help you get a better feel for the true tax advantages to see how you can apply this to your own personal situation. Now, before we begin, it's important to note that these benefits exist to aid investors, but they apply to everyone's situation differently. I am not a CPA, and when it comes to how these strategies will impact you, it is extremely important that you consult with your CPA or tax counsel to be able to make sure you're clear on the specifics of these and how it's going to impact your own personal situation. Number 1, depreciation deductions. Over time, the physical condition of commercial real estate property deteriorates due to exposure to natural elements and normal wear and tear from its use. Believe it or not. To account for this, the IRS rules allow for property owners to depreciate or expense a certain portion of all of the property's value over its useful life, as defined by the IRS. This is a non-cash expense, but it serves to reduce the amount of taxable income produced by the property, therefore providing a reduction in the amount of taxes may be paid, because this creates what we call a paper loss. Property owners can choose to be more aggressive with the depreciation strategy, choosing to accelerate them using what we call a cost segregation study, which allows the investors to bucket the asset into different components and depreciate them at an accelerated rate. So this sort of accelerated depreciation is able to reduce tax payments even further. And in addition, in more recent years, we've had the advantage to also use what we call bonus depreciation, where for all of the accelerated depreciation, we're able to receive it even faster, even sooner, year 1. So RV campgrounds and mobile home communities provide a unique opportunity for investors by offering a more aggressive accelerated depreciation schedule than a lot of other asset types. Cost segregation identifies qualified real estate property that can be depreciated in as little as either 5, 7, or 15 years. Items such as utility tie-ins, gravel, asphalt driveways, lots, signage, landscaping, and pathways can all be accelerated for quicker write-offs under the existing tax rules because they depreciate sooner. This means that the value of cost segregation on these asset types is greater than ever. Number 2, cost segregation is a tax planning strategy that involves identifying and separating certain elements of a property's construction or renovation costs into shorter depreciation periods. This can result in larger tax deductions in the early years of ownership, which can provide significant benefits to investors in a real estate syndication or investment. Cost segregation takes into account a mix of personal property and real property, such as personal property being your appliance and your fixtures, and then your real property being your walls and your flooring. So a cost segregation study is ultimately going to help investors go and identify which elements of the property are going to qualify for shorter depreciation periods. Think about it like this. You'll have a mixture of both personal and real property, and they will break it down into buckets that will either be 5-year buckets, 7-year buckets, or 15-year buckets. And then you'll also have some that falls under your traditional 27.5 or 39-year buckets, meaning that certain elements of the property are going to depreciate quicker than other elements. So by allocating more of the property into the 5, 7, and 15-year buckets, investors are able to claim a larger tax deduction in the early years of ownership. It's also important to note that when a property is sold, those deductions may be subject to depreciation recapture, which is accumulated depreciation that may be subject to income tax. There are several alternatives to selling a property, such as refinancing and 1031 exchanges that we'll get into, that will help investors defer the payments of capital gains, sometimes even indefinitely. Now, with cost segregation, again, you have accelerated depreciation schedules, meaning that you're able to receive those losses on a faster timeline, and using current laws that have been in place in recent years, having that bonus depreciation allows you to receive a lot of that upfront year one. We generally find that the net effect is positive for investors to take the time and invest the money to go and get a cost segregation study on most commercial real estate assets valued at $1 million or more. All right, now for those that like to get into the weeds, I want to do a quick breakdown on how the math works, because I know this is one of the questions that I had early on. And we're going to look at an example of an apartment building, and this is purely for example purposes, just to help you better understand the math on cost segregation and accelerated depreciation and how it works. So if we look at this, we have your typical apartment building. Let's say that we bought it for a $10 million purchase price. Then out of that $10 million, we can say that 20% of that goes towards the land. So we put a land value of $2 million on. Land does not get depreciated. So land does not have a useful life because it effectively is looked at like it has an infinite life. So that means that you have $8 million out of the $10 million purchase price that can be depreciated over time. And if we look out of that $8 million, we'll say that 30% of the $10 million goes towards 27.5 years. So that means $3 million out of the $8 million is depreciated on your standard residential 27.5 year schedule. But after your cost segregation study, you had the engineers come out to your property and walk through all the units and identify all of the structures, and you actually had them, they've realized that about 40% or 50% of your purchase price could actually fall into the 5, 7, or 15-year buckets, which are faster depreciation schedules. Therefore, during the current, where things currently stand, we are at 80% depreciation. For years, it's been 100% depreciation. So a lot of that could be realized as a loss up front year one. So that's just a brief, quick example of showing if you had a $10 million purchase price, how you'd have it broken down into, say, for the example, we have 15% of it goes, 15% of the $10 million, $1.5 million is on a 5-year bucket, 15% is on a 7-year bucket, 20% is on a 15-year bucket, and then 30% is on the 27.5-year bucket. So that means that those are all going to be accelerated on different schedules that you'll see losses reflected in tax returns for. So number 3 is lower tax rate on long-term capital gains. So capital gains that are achieved after the sale of commercial real estate property are subject to capital gains tax. Now the benefit here is that long-term capital gains are taxed at a lower rate than a regular income tax. Now the exact tax does vary by the time, based on the time the property is held and the filing status of the investor, but generally any gains on the sale that is held for more than 12 months are taxed at long-term capital gains tax, which is less than ordinary income tax for most. Holding long-term provides significant savings to the tax percentage charged to investors. Now, as mentioned, there are several alternatives to selling a property, such as refinancing and 1031 exchanges, that also help defer the capital gains taxes, often indefinitely. Tax advantage number 4 is the refinance or refinancing. Most commercial assets are financed with commercial mortgage debt, either through banks, agencies, or insurance companies. Now, one of the huge advantages is after operating an asset for long enough and increasing the value, you're able to go ahead and do a cash out refinance. And the benefit of this is this ultimately means that you're paying off your existing loan, putting on a new loan, usually hopefully at a greater size, of equal or greater size what the former loan is, And with a cash out refinance, that means that you're getting a loan large enough where you're able to not only pay off the existing loan, but in addition to that, put some money back into the property for, likely you should be setting aside money for reserves, and you still have additional cash that you can then distribute to yourself or your investors, depending on how you structured the deal. So this is one of the real estate investors' favorite things, because this is a large inflow or capital event that takes shape, and when you're receiving those additional loan proceeds or your cash out, those generally are not subject to tax because they're just additional loan proceeds, and it's not, you're not realizing any form of taxable event. So this can be huge and one of the most sought after tax advantages for real estate investors. And number 5 is the 1031 exchange. Now, we discussed earlier that the tax laws require investors to pay long-term capital gains when there are investment gains on the sale, which is true, but a lot of savvy investors will actually defer these by using what we call the 1031 exchange. In this program, capital gains tax are deferred as long as the sales proceeds are reinvested into another property that is what we call like kind, usually another income producing property. There's no limit on the number of 1031 exchanges that can be completed, so it's theoretically possible that an investor could continue to roll from one property onto the next, allowing their money to continue to grow tax-free or tax-deferred over a long period of time. A syndicated real estate investment can be a really effective strategy for high-income earners to be able to reduce their taxes that they must pay each year. For passive real estate investors, the bottom line is that there are numerous tax benefits that result in lower taxes over time. Lower taxes means more distributions, keeping more of your profits, and for that reason, commercial real estate investments continue to be a very popular choice for high-income earners and those looking for strategies to be able to lower their tax bill over time. So thanks for joining us today on Requity Insights, and we look forward to seeing you again soon. Thanks for tuning in to another episode of Requity Insights hosted by our team at the Requity Group. You can find recordings of all shows along with our opt-in form to set up a call and view future investment offerings on our company website, therequitygroup.com, also listed in the show notes.